Hi Vivek, we are live on both the platforms and we have people joining in right now.
Okay, great. Can you hear me?
Yeah, I can hear you pretty well. Perfect. So let's wait for a couple more minutes for people to join in and then we can begin. Meanwhile, everyone, please feel free to ask your questions in the chat box and we'll be happy to take them at the end of the session in the Q&A round. Okay, it's 6:05 now. Vivek, I would request you to share your screen and I'll just introduce Estee and ourselves to everybody. Firstly, thanks everyone for being with us on an evening on a weekday. Um, we are very glad to have seen such a tremendous response to our products, both our PMS as well as Good Luck products. So very happy for all of you to be here, and we'll be talking about our PMS services in detail today with Vivek, who's the investment head at Estee and Good Luck. Vivek, if you can go to the first slide, please. Yeah. So a little bit about Estee for people who are new here. Estee is a pioneer of systematic investing in India. We started our operations in 2008 when SEBI had permitted algorithmic trading in India. So as you know, we specialize in quant-based investing. All our decisions are made using computer software's quantitative methods where we analyze more than 130 factors to come up with the advice that we give based on our portfolios. So over the past 14 years, we have been developing leading investment and broking products. And we operate in multiple countries. We have an AUM of over 1,500 crores in our PMS and over 350 crores in our Good Luck products. We also received NSE Institutional Member of the Year Award in 2019. So this is about Estee. Some people might know about Good Luck. Some of you might be our investors in Good Luck as well, which is our product for retail investors who are more interested in starting out small. But for people interested in PMS, this is a good forum to discuss on what we can offer and what are your needs. About the team, of course, Mr. Sandeep Tyagi, he's the founder and CEO of Estee and Good Luck. He pursued BTech from IIT Delhi and is an alumnus from Columbia Business School. He has 30 plus years of experience in portfolio management, analytics, and consulting. And we're happy to have Mr. Vivek Sharma, who's the investments head at Estee and Good Luck. He did his BTech and MTech from IIT Kharagpur and has 20 plus years of experience in trading and investment management. Vivek also was leading a team at Futures First. Many of you would be knowing about it as well. So Vivek, I invite you to talk about our PMS products, and we'll be taking questions of those who have registered and who have shared questions in advance with us at the end of the webinar, along with the questions that come up in the chat box. So I urge all of you to feel free to share as many questions as you have with us. Over to you, Vivek.
Thanks a lot, Isha, and welcome everyone. I'll quickly take you through our Quant PMS. We have two PMS that today we'll be speaking about. One is Long Alpha, which is purely equity-based PMS, and the I Alpha, which is a arbitrage PMS. So we'll start with Long Alpha PMS, which is a pure 100% long only equity-based product. The universe here is BSE 500. So we select stocks from all large cap, mid cap, small cap. It's a flexi cap fund. And just to share with you the performance, so we have been live since almost 4.5, 5 years, and the current model which is running, if somebody would have invested 50 lakhs in about May 19, BSE 500, you would have made about 1 crores overall portfolio value, whereas this has done almost double of that. So almost more than 2 crore portfolio value by investing 50 lakhs. So this is what we have been able to achieve over last 5 years or so, right? And I want to now focus much more on the methodology, how we have been able to achieve this, right? So this is last year's performance and year-wise performance, and as you can see, uh, out of those overall 6 years, 3 years we have done almost equal to benchmark, but 3 years we have hugely outperformed the benchmark. And what this has led to is almost 17% alpha over and above BSE 500. Right. Now, what we do is we are a quant-based firm. All our strategies are purely data-driven and systematic in nature, and we use what is known as factor investing. Now, some of you might know, some of you might not have heard, but there are some certain factors, and NSE on their website also have a few factors related data. And these are the four most popular factors: momentum, low vol, and I explain what are these. But just in terms of the performance, how these specific factors have done over last 14, 15 years, you can see all these four factors have beaten the Nifty 50 easily. And momentum obviously being the best one, but even low vol, value and quality have given better returns, better absolute returns also, and better risk adjusted returns as compared to Nifty 50. So what this tells us is factor investing actually works and it works over long term. And all of these four factors have been able to beat the benchmark, right? And if you consider the long alpha's performance over since we have been live, we have been able to beat even the best of this specific factor, which is momentum. So we have done much better than momentum factor, and these are yearly performance. But overall, if you see the risk-adjusted returns, long alpha would be much better than the momentum factor as well. So we are not as volatile as any other index or even momentum. So what we have been able to achieve is with much lower volatility. Now, let me quickly take you through these factors that I'm talking about. What exactly are these factors, right? So momentum, what is momentum? It just reflects how strong the returns have been historically. So one can take past 3 months, 6 months, or 9 months, or even longer returns, and then see which are the companies which have given the best returns and select only those specific companies. So you would be using momentum as a factor if you are doing such a thing, right? Value, again, a very, very popular factor where many fund managers, what they do is they pick the undervalued stocks. And the basis it could be captured by low price to book ratio or price to equity ratio or any of these other fundamental factors. You just study how valuable a company is, and if it is undervalued, you actually invest in that stock, right? The other factor is low volatility. Again, quite a popular factor in this. What is done is stocks whose prices are uh, relatively lower volatile than other stocks. You select those kind of stocks only. And what studies have shown is the way if you pick low volatile stocks, your returns are actually higher, which is a very counterintuitive thing because most of the people understand that in order to make higher returns, you need to take higher risk. But low vol factor is quite different in that sense that you are actually picking up low vol stocks and still you are able to beat the benchmark indices. And the way it could be measured is one of the simplest ways could be standard deviation. Obviously, you can do a lot of mathematics around it to figure out other ways of measuring volatility, right? And then there's quality factor where stocks that are characterized by, let's say, low debt, stable earnings, or other quality metrics uh, like return on earnings, earnings stability. All of these multiple ways you can capture a quality of a company or quality of the fundamentals of a company, right? So these are just four factors. And what I want to show you next is these factors, they keep on rotating. Like, sector performance keeps on rotating. Last year was very good for real estate. Prior to that, it was pharma. Prior to that, it was IT. So the sector performance keeps on rotating. It's not one factor that is consistently doing well every time, right? So these factors keep on rotating, and what we are doing in our multi-factor approach that we have developed is we are not only tracking these 4 factors, but we have made a list of about 130 factors that impact stock prices. Now, some of the other factors I can talk about, it could be let's say index reconstitution, right? So if a stock is about to enter an index, it could be, let's say, Nifty 50. So you will have strong momentum behind it. Or if a stock is getting out of Nifty 50, it will be a negative bias for that specific company. It could be insider buying. So companies' management or company's promoter, if they are buying a specific stock, it tells you something about how confident they are about the prospects of that company, right? So that could be one of the factor. Another factor could be institutional buying, or factors like some of the macro factors also, like oil prices. Now, oil prices does not impact all the sectors equally. Some sectors it impacts in a positive way, some sectors it impacts in a negative way, whereas for others it really does not matter, right? So we have tracked and we have figured out these 130 factors that impact almost all the stocks and even sectors, right? And then what we do is we try to figure out uh, we try to figure out in the current market regime which specific factor is more likely to work. So what I've been seen historically is in a growing market, when all things are nice, momentum works very well, the growth factors work very well. Whereas in a sideways to downward going market, factors like low vol or value works. So if you're just relying on one factor, that is not really the best approach. The best approach would be if you are able to pick out the factors that are more likely to work in the current market regime. And that is how we are also adding value, right? So in Long Alpha, the way we are adding value is obviously these 130 factors, which is a combination of fundamentals, technicals, and macro factors, right? Now we keep on rotating factors depending on the current market regime, and that's how we allocate weight to these factors. There we are adding value, and obviously better definition of these value factors, right? The way we combine factors, we have tested it historically over 12 years of data and in multiple geographies so that our systems are very, very robust. And lastly, because this is a systematic approach, our systems really won't get greedy or fearful like humans can get, and even fund managers can get, right? So this form of investing, it totally eliminates the role of emotions. At times emotions play a positive role, but we know most of the times emotions are playing a negative role in our decision making, right? So that's how in Long Alpha we are able to add value in our portfolio approach. Now this is the market cap wise allocation for about last 13-14 months, and as you can see here, in the last 12-13 months, large cap on an average has been about 20% of our allocation, mid cap has been about 40, and small cap has been another 40. But this can change, this does change month on month. And if we see, last year was very good for mid caps and small caps, and hence we had much higher allocation. But tomorrow, if let's say the markets are sideways or going down, and if the algorithm sees that we have much better opportunities in large cap, we'll actually keep on shifting. In fact, our large cap allocation slightly have increased over last 3-4 months since October, where we made a low about 17%. I think in February it was about 22-23%. And wherever we see opportunity, if we see more opportunities in large cap, we'll keep on shifting our allocation there, right? This is for last year. So as you can see, large cap had 19% allocation, whereas in BSC, the large cap has 86% allocation. But the more important thing here is the large caps last year were able to produce about 26% returns, whereas we in our picks of large cap, we were able to generate 52% returns. Similarly, for mid cap and small cap, because of our stock selection methodology, we have been able to pick much better stocks in each of these three categories. So you can see even in small cap, last year was pretty good. We got 25%, whereas in long alpha, the small cap picks gave 39%, right? So overall for last year, the BSE gave 26%, whereas we were able to generate about 58% returns because of the better pick from each of these three categories and also from these sectors. So the same thing is happening in sector also. This is the sector related weight and the returns for last year, right? So the biggest sector is obviously financials giving 17%. So last year being 26% for BSE 500, financials actually underperformed quite a bit. And also IT, it underperformed the overall benchmark index, right? Whereas for long alpha, our weightage to industrials was 22. So the three biggest sectors for us was industrials, financials, and consumer staples. But more importantly, how we allocated weight and how we were able to pick the best stocks from these sectors. So if you see industrials, we were able to generate almost 100% returns, more than 100% returns in industrials. Whereas in BSE 500, these industrial companies gave about 48%. So again, better allocation of capital and better picking of these specific stocks from sectors. So I think from all of these, only one sector where we are not able to do a good job was utilities, where we actually lost about 70%. But the good thing here is actually the allocation to utilities was very, very low. So it really did not hurt us. So some of the best performing in terms of returns also had some of the best allocation in our methodology, right? So broadly, two areas, two ways how we are able to do well. This is really important. How much risk we are taking in order to generate these good returns. So if you see our Sharpe ratio, which is a measure of, again, the risk adjusted returns, our Sharpe ratio is more than double that of BSE 500, right? So what this tells us is for each amount, each unit of risk, we are able to generate double the returns of BSE 500. Again, the volatility, which is measured by standard deviation, for BSE 500, it is 19%, whereas for our portfolio, long alpha, it is 17%. Max drawdown, again, this happened during COVID. Max drawdown for BSE 500 was 30%, whereas our portfolios lost about 18%. Right. So each of these three measures tells us that at least historically, the risk we have been taking in our portfolio to generate higher returns is really equal or actually lesser than BSE 500. Now, you would know that some of the other PMSs or even other model portfolios, one of the ways to generate good returns is you just make a very, very concentrated portfolio, take higher risk. But that is one way of generating returns. We really do not believe in that way of generating returns. We believe that a good consistent growth for long term is only possible if we are able to contain our risks. So risk mitigation is really very, very important for us, and that's how we want to construct our portfolios. So yeah, regarding risk also, we have been able to. Now this is as per BAP test. If you see, historically, we have tested since 2012. And the orange line is BSE 500 and the blue line is the current model of long alpha. And if you see in all of these three big drawdowns, long alpha has actually lost much less or relatively less than BSE 500. There have been instances where we lost more into 2017, where markets just fell about 7-8%, but we lost about 12%. Here in 2019 also, we lost a bit more than BSE 500. Net overall, if you see the drawdowns, I think we are doing a pretty good job of containing our losses during these bad times. Yeah, I think that's it from our side. This is the last slide related to long alpha. So currently we are promoting this and offering good discounts. We have three options. One is the fixed fee model. One is purely on the basis of performance. And the third one is a hybrid model in which we charge some fixed fee and some hurdle. So depending on whatever you like, you can actually choose these fee options, and there's no entry or exit load in our PMS schemes. Yeah. So I think I've spoken everything about Long Alpha. We can take questions if there are any.
Yeah, Vivek, there are tons of questions coming on YouTube as well as the chat box.
Okay.
So let me take something about the fees first. Santosh Patil, who's attending the webinar currently with us on Zoom, has asked that, okay, so he mentions that the PMS charge of Long Alpha is 2.4%, which is much higher than what I pay for Gear 6 small case. So Santosh, firstly, the good news for you is that we are offering this at a 60% discount on fees. Vivek, is there a time period? Is this a limited period offer or?
So this is definitely till March 31st. We
Okay.
really don't know whether we'll be extending this or not, but this is there till 31st March.
Perfect, perfect. So there is a 60% discount currently being offered, Santosh, on the Long Alpha PMS. And the further question, Vivek, is that he understands that the PMS is more diversified, but what extra will they get in terms of returns? This was linked to the pricing question. Secondly,
Okay.
he says, apart from PMS charges, are there any additional charges to be borne by the investor, and how often are reports shared on the status of the investments?
So reports, we do monthly reporting, and obviously you will be getting a login ID password so that you can track if you want to on daily basis as well the performance. But from our side, we send out the reports on monthly basis. Regarding the fees, I think one of the question you pointed out was what extra we'll get. I think returns wise, you would not get extra. Right? I would expect higher returns in Gear 6, but that is a more concentrated portfolio. It's meant for somebody who's investing much smaller amounts.
Right.
This portfolio is meant for people who are investing much larger amounts, typically 50 lakhs plus, right? So we really don't want to offer a concentrated portfolio for these kind of customers. And obviously, as I've shown you, the risks are also lower in this. So risks are obviously lower than the BSC 500, which has 500 stocks, but it is also lower than Gullac Gear 6. So if you see the risk adjusted returns, the Sharpe ratio, I think will still be much better or equal to what we are offering in Gullac Gear 6. Another thing is, I think in terms of what the returns that you see, we have pointed this out on small case. What happens is what is reported is the theoretical or the gross returns.
Right.
So what is missing from that is the brokerages, the other transaction STT and other charges, as well as the slippages, which could be substantial if your portfolios are bigger size, right? Whereas the returns that we are reporting here is net of everything except the fees. It's net of everything. So the brokerages, STT, the transaction charges, the slippages, all of this, after all of this, you'll get these returns. So that's why I think, and also the 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 rebalancing. Sorry, the rebalancing that we do, we have made our own execution algorithms so that we are able to execute or buy or sell at very good prices, right? Again, coming back to small case, if you are executing, you just are paying that bid ask spread. You'll hit the market. So if the buy price is at 100 and the sell is at 101, you'll actually, if you want to buy, you'll end up buying at 101. Whereas our execution algorithms, we have spent a lot of time on it so that you get the best price possible, right? So I think fees is definitely, obviously, it's higher even at 96.96 percentage. It is higher than Gullac. But I think there are definitely advantages. And one of the big advantages I told you is obviously we do not charge, your brokerage fees would be zero, right? And in terms of execution, the slippages, I think we'll be able to avoid those slippages so that it makes up more than makes up for this higher fees actually. That's my view. Yeah.
Perfect.
On fees, on risk returns. Yeah, I think I've covered everything.
Right. And there are no additional charges. Like he asked,
And there's no additional charges. Yes.
apart
Yes.
from this, what you see on the screen.
Yeah.
Perfect. So there is a follow-up question from him. He's saying, is the discount only for the first year?
No, the discount is for life. If you enter before 31st March, it is for life. So up until and whatever, if you let's say add on more money after this discount ends for others, but you will still be charged this fees forever and for all your portfolio value, even for the new money that you invest in Long Alpha.
Perfect, perfect. So there are a couple of other questions from Santosh itself, which are pertaining to what we have discussed. So I'll ask them. One is the PMS, when in the PMS, do you invest the whole amount at one go or is it in a staggered manner?
So in PMS, we do invest the amount at one go, right? But I think staggered one, I'll just take up iAlpha. And please remind me, I'll cover that how you can manage or how we can help you stagger your investments using iAlpha. So let me take you through iAlpha first, and then I'll answer that second question. Okay.
Sure.
We can take other questions related to Long Alpha.
Sure. So I think you've answered Arnav. So we are live on YouTube as well as LinkedIn.
Okay.
Arnav from YouTube has asked a question that you've already answered. He asked about the returns, the charges, and the minimum investment if it is 50 lakhs or different from.
Yes, because this is a PMS, the minimum investment in PMS is 50 lakhs. But let me quickly take you through the second PMS, which is arbitrage, because I think it will help us answer the other questions also regarding the minimum investment. So this is an arbitrage PMS. Again, this has been running since 2009. And as you can see from the track record, this is actually meant for very, very conservative investors who typically invest in FDs, right? And our aim is to produce FD plus 2 to 3% net of all charges, including fees. That's what our aim is. So it's slightly better than FD. And you can call it as safe as FD also, because at least there are definitely other kinds of risk, but at least in the last 13, 14 years, the way it has performed, we have seen not even a single losing month, not even a single negative month we have seen in this, right? And the average performance has been about 12 to 13%. It's one of the most consistent products you'll ever see in the PMS, right? Uh, so this is the arbitrage fund again. And how we are able to achieve is because of the excellent infrastructure that we have created within Estee. So we have some of the best high frequency infrastructure that is available in India, and all of it is developed in-house by our engineers. Like per second, we are evaluating almost 5,000 opportunities. Number of securities that we are seeing is more than 1,000 securities per second, and number of orders is again uh, 10, more than 10 per second. So we have these big infrastructure edge, because of which we are able to generate these very consistent high returns, right? And again, this is the fee structure. But more importantly here, what I'd like to point out is because this is meant for somebody, a very, very conservative investor. So what investors are also doing is, one of the questions was regarding staggering investments, right? So the way we suggest is, let's say you want to invest only 25 lakhs, 50% of your overall corpus in equity right now, and rest you don't want to invest. So the way it can be planned is you invest 25 lakhs in Long Alpha, and rest 25 you put in iAlpha, which is an arbitrage fund, right? And whenever you want, you can actually make these shifts. So if the markets have corrected, if you want to stagger your investments, let's say over the next 6 months. So what you can do is over next 6 months, you can actually shift 1/6 of whatever you have put in iAlpha to Long Alpha in a very, very systematic manner. That's how. And the point about minimum investment, the minimum investment is 50 lakh across these two PMS. So you can divide that 50 lakh the way you want between equities and between debt, right?
And we are saying that iAlpha is more of a debt product.
Right.
The constituents. Understood. Okay. Let's look at more questions. So Amit Patil is asking that he's curious to know about our programming tools or the analysis software that is used to make such large scale analysis.
So, frankly, we are not using, and these kind of softwares are really not available in the market.
Yeah,
The way we do our analysis, so everything that all the analysis that we do, everything is actually developed in-house by our engineers.
right.
So really can't tell you any off-the-shelf softwares. They might be available in the market, but for our use, frankly, no such software exists. So everything has been developed from ground up within our firm.
Yeah. And just to add to it, Amit, because I'm also part of the team that works for, people who want to use our brokerage services, high frequency trading
Yeah.
services. So I can add some color to that. What happens is that in NSC, there is a co-location facility where you can place your infrastructure, which allows you to place orders which are as fast as 1,000 orders per second. That is the extent to which you can place orders. So we do have, since we are a broker and we are present in NSE co-location, we have a lot of infrastructure that is placed there, which we are giving out to our brokerage clients as well as using in-house for our PMS products. Now, these are, so we have created, there is a huge team of coders from IITs, from ISB, IIMs, all kinds of good colleges, who are working on developing these investment products as well as the execution, so the brokerage products. And what we do is we not only work towards the strategy, we also work towards how to execute the strategy. So we have a lot of models which help in taking advantage of the arbitrage. For example, this Alpha fund, we can tell more about it, but we are actually taking benefit of the arbitrage opportunities, and through our executing software, we are able to place orders quicker than the other players in the market. So it's not just strategy, but also execution. That is our USP, which we are utilizing to produce these returns.
The point about fees also in Long Alpha, as I
Hmm.
mentioned, that because we have developed these execution algorithms, I think the slippages that one would encounter uh, when we rebalance that 50 lakh portfolio versus when somebody else rebalances using small case execution, I think there's a huge difference. And that difference only makes up, more than makes up for the higher fees actually.
Right, right. Okay, so tons of questions coming in, Vivek. Okay, I'll take them one by one. Santosh is asking, is partial withdrawal possible from the PMS?
So partial, see, if somebody has invested just 50 lakh, then it won't be possible. But if somebody has invested higher amount, then it is possible. Or if there is profit, let's say profits generated, you can obviously withdraw those partial profits.
Okay,
One difference is there in Long Alpha, the redemption cycle is just 3 to 5 days. So whenever you inform us that you want to redeem some partial or full, it will be redeemed within say about 5 days. I-alpha, because of the nature of the strategy that we are doing, the redemptions are month end, or the new capital that investors want to put in, it's only at month end, right? So that's a small difference between redemption cycle for these two products.
understood. So this is also linked to the question from Aditya Singhal on YouTube. He's asking what kind of monthly payouts are available off the returns so that the investors can consume it. Similar to, I think, the profits or the monthly payouts. How frequently they can consume it and how frequently they can apply for it and to what extent?
Uh, Sorry, you asked about the redemptions.
The monthly payouts, Vivek, if there are any monthly payouts.
See, there are no monthly payouts as such, but what people have done, see, Long Alpha, because of the nature of the product, it is investing into equity. So we know that not every month will be profitable. There will
Hmm.
be few months which are in profit, few months which are in loss, right? So I don't think people use Long Alpha to withdraw profits really on a monthly basis, but I-alpha is that product, right? So I-alpha is that kind of product. People have put their retirement money also in I-alpha, and they've given us instructions that they want to withdraw whatever profits are there, they want to withdraw it every month. So that kind of withdrawal is possible, and people are using that kind of withdrawal in alpha. It is also possible in long alpha, but every month if you're not making profit, there's no point of withdrawing. If you want to withdraw, obviously you can withdraw some money from long alpha as well.
Understood. Okay. Another question related to this is, what about taxation for the investor for both long alpha as well as I alpha? Is tax accrued only when withdrawing?
Not at withdrawing, because in long alpha, the transactions are being done in your demat account. So it's equal to when you are buying or selling shares in yourself in your demat account, right? So depending on whether these are short-term or long-term capital gains tax, you'll need to pay 10 or 15% in long alpha. Whereas in I alpha, the way it happens is a part, whatever returns you are getting, a part is the interest income, and one part is the trading income, which is from FNO, right? So that is how, so it will be taxed similar to what individuals pay in FD. Right? Okay. But the nature of earnings is, one is interest income, one is the business income through FNO. That's how it will be taxed.
Perfect. So Vikram Dudani is asking that currently the general opinion is that there is a lot of froth in small and mid cap. Does your IP suggest any lead indications on this?
So there is froth, but at least from the way we are seeing right now, I think there are definitely opportunities also available there. So as I showed you, we have about, I think currently we would have about 25% in large cap and rest 75 in mid and small. But the good part about this algorithm is it is self-correcting. So based on the data that we keep getting, it might so happen that if we keep finding more and more opportunities in large cap, this 25% will keep on going up to 30, 35. It can keep on going up, right? So it is self-correcting, auto-correcting in that it will take up all the new data and then decide, right? Ideally, we never decide on our own, because we trust this systematic way of investing, and we have seen the live results also. It's not that we are showing the back-tested results.
Right.
We've seen the live results where it has done over last 5.5 years. So yeah, that's what it is. We do not take any market related calls, whether market is high or not, or whether small caps or mid caps are high or not. All of those things are actually built in. So when I told you that we are having 130 factors, out of those factors, roughly 40% of the weightage of those factors would be in fundamental related factors, that 60 would be technical factors. So when we say fundamental factors, all of these things get picked up. If there is froth, if there is very high valuation and we are getting better valuation elsewhere, we'll actually shift the allocation there. But from our side, we don't like to predict, right? We prepare that whatever has happened, based on that, we prepare our portfolio for the next month, but we really never predict that what would happen in the next month.
Makes sense. Now coming to the next question. Okay, so an anonymous attendee is asking that there are years where none of the factors did well. How to position in those years to get alpha, such as 2022? And someone
really
else is asking that 2022, if you can share the sectoral allocation returns, alpha, etc. for the year 2022.
So I do not have that with me right now. Okay. But what I'll share is one thing, that if you, if your queries are actually not answered, what you can do is my screen visible?
Yeah, Vivek, it's visible.
Yeah. So what I would urge everyone is, if for some reason your queries are not answered, here's the contact details. You can call us or email us or visit this website to get more information. So this specific question about 2022, where factors were really not working, I do not have that right now with me, but we'll be happy to share. So please do get in touch with us. But your question was that there'll be certain years when nothing is working really. So how do you position? See, I really think that equity investing, if you have longer term view while investing, it will be much better for us as investors, right? So not every year will be profitable. Not every year we will be able to beat the index. That will happen. And one should not try to do that also, right? We have seen some of the best investors like Warren Buffett, right? Warren Buffett has been underperforming for many, many years. Even in this last 2 3 years, they have done phenomenally well. But before that, for 5 6 years, Berkshire was actually underperforming the overall benchmark index. And he was pretty convinced that he has seen his approach works across decades, and he was convinced that it's okay. He's willing to stick to his approach, even though it's not working for 3 4 5 years. And ultimately, if you consider these 2 3 year returns also, and then take the overall last decade, I think they have done pretty well overall. So I really do not think that one should try as investor to beat the market in every month, every quarter, or even every year. There will be definitely some down years, and the aim should not be to beat in every single frequency. That is not our aim is. But having said that, what we also do is we keep on improving our algorithms. So the learnings that we have seen in 2022, what we have done is we have improved our algorithms so that if such a thing happens in the future, at least as per us now, we are much better prepared, right? So we have made significant improvements in our algorithm. Currently, the model that is live, that tells us that if 2022 kind of exactly were to happen, which it really won't happen, but if it were to happen again, we'll actually be producing decent alpha in that year. But again, this is as per back test, right? In 22, we really did not do as well. It was kind of very, very flattish year. But I think we are better prepared now. We'll keep improving. A large team is actually working day and night just to improve our results, irrespective of whether we are doing very good or very bad. Their aim is just how you can actually, based on the new data, based on new learnings, how can we make our models better? So I think that's what we are. We are better prepared to handle. Again, nothing is sure, but I think we are better prepared for these kind of situations.
Yeah, thanks a lot, Vivek. Uh, okay, so other questions. I'll take a couple more questions from the chat, and then we have questions from our viewers who had filled up the form and sent us questions in
Yeah.
advance. So one question from Santosh Patil here is that how is long alpha PMS different from investing in a mutual fund, say a flexi cap fund? This was also in our form. One person had asked the
Yeah.
difference
Yeah.
between PMS and mutual fund in general.
Yeah. See, one is obviously the taxation. Mutual fund as a investment vehicle is very, very tax efficient, right? Whereas here we are buying and selling stocks in individual demat account. So taxation wise, obviously mutual fund is no better investment vehicle just on the taxation front, right? But I think the way we are doing things, uh, we are adding a lot of diversification to people's portfolios. So most of the mutual funds are kind of discretionary in nature, right? Whereas the way we are picking stocks is purely on the basis of quant, which has fundamentals, but a bigger part is actually technicals. So that lends some diversifications to people's portfolios that not all are discretionary. There's some quantitative allocation and some allocation to these discretionary funds. That is one thing. And second thing is, I frankly believe that currently there is not too much of competition in the quant space, and that is why we are able to produce this good alpha. And I don't see really meaningful competition in the next 3 to 5 years. Hence, my conviction is that we'll be able to keep producing decent alpha at least for the next 3 to 5 years, right? And that is why I think we'll be able to do much better than most of the mutual funds. There'll be definitely few mutual funds who would do very well, but I think this is a different style of investing. One should invest more so for diversification rather than for higher returns that we have been able to produce.
Okay, so Vivek, digressing from the topic a little, we have two questions. One from Pareen Rabadia in the chat right now. He's saying that he's from Jamnagar, Gujarat, and he's a Gullak Gear 6 investor. He's accepted Gullak Investor Meet invitation happening in Gurgaon on the 2nd of March, and he's awaiting confirmation from us. So he needs the confirmation because he needs to arrange for his travel from Jamnagar, Gujarat to Gurgaon.
Okay,
So this is very sweet of for me to see that people are actually traveling to be part of our investor meet
right.
from different states also. I think Vivek will be sending out invitations by tomorrow, right?
Tomorrow morning, I think in the first half, we'll be sending out the invitations.
Perfect, perfect. So Pareen, I have noted your name. We'll definitely send out the invitation to you and we'll get in touch with you. You can also get in touch with us. The customer support number of Gullak is on our website. You can ask any question or about the investor meet. We'll be happy to share. So another question related to this was by Kalpesh on YouTube, that what will be happening in the Gurgaon meeting? And can we have it in Mumbai? So there is a lot of interest, clearly.
So yeah, we have been receiving very, very good interest from other cities also, and I think we'll do definitely plan this out. Because we are based in Gurgaon, it's easy for us to conduct our first investor meet here, but we'll
Yeah.
definitely do plan it out in other cities where investors are located. Yeah.
Yeah. And on the agenda, I think we'll be talking about, so Sandeep has written a book and we'll be talking about certain excerpts from the book. Apart from that, we will also cover details on our Gullak investment philosophy, and it will be a community of investors, right? The investors who are with Gullak. So any questions that you guys have about Gullak, there'll be Sandeep, there'll be Vivek, there'll be our vice president also. So whatever questions you have, you can ask, you can throw at us, you can interact with the other investors that we have, as well as our potential leads. So there'll be a gathering of, I think, around 150 to 200 people, and it will be a community where you can ask questions and connect and network with people.
Yeah. But this is primarily really not so much good luck, but investing philosophy, our investing philosophy in general. So
Right.
we'll obviously talk about other things, mostly other things, and a little bit maybe about our approach to investing, but investing in general.
Investing in general. Right.
Yeah.
Perfect. Okay, Ramesh has asked a question on deploying funds in a staggered manner. So Ramesh, you're on YouTube. You can always rewind the session. We have already covered this question. There was another question by someone asking if the session is recorded. So the session is available on YouTube right now. It's on YouTube Live. We will be retaining the recording on YouTube and you can rewatch it at your own convenience whenever you like. So most of the questions that are coming now have been answered, have been catered to. So please rewind the recording. Okay, so an anonymous attendee is asking that he's invested in Gear 6 with 51 lakhs. So he's saying he sees slippages on rebalance days. And he wants to understand if long alpha PMS would be better suitable. So,
See, as I've explained, long alpha is more diversified. So in terms of risk or volatility, it will be lower volatility, lower risk than good luck. Returns obviously would be slightly lower. In the long run, obviously, we have seen big difference in returns, but we really don't, as per us, we really don't see big difference. This difference is really very, very minimal. Now, talking about rebalance, I think that's what I was talking about some time back, that these big accounts now are observing these very, very high slippages. And the second part also, which I did not cover, is currently we are unable to, in good luck portfolios, we are unable to rebalance 100% of the portfolio on that very day if we do not have that excess funds, because only 80% of the funds that we, of the stocks that we sell, is available to us to buy. So if you do not have excess funds, you'll actually need to go and buy the next day, right? So that again causes a lot of slippage. Whereas in long alpha, we will be rebalancing. And we will be rebalancing everything at one go, right? So the execution is much better. The slippages obviously are lot lower, and you do not need to put in any extra money. We'll be rebalancing. We have ways to we have figured out how we can rebalance everyone's portfolio on that very day only when rebalancing is required. So all of these are advantages as compared to Gear 6.
Right. So Jitendra is asking, is it the right time to invest in PMS when the markets are at an all-time high? The very common question we receive for
Yeah.
Gulak as well as like all kinds of investments. We've been hearing this question.
Yeah. The frank answer to this is I do not know. I do not know whether the markets are going up or down next month or this year. What I know is that 3 or 5 years down the line, market should be much higher. And that's where we want our investors to focus, not on the short term. And again, if somebody is, there are few investors who sell their equity in, let's say, in other PMS or somewhere else, or they have their individual stocks and then transfer the money. So for them, it's really no difference because they have invested that 50 lakhs in equity somewhere else and they'll be putting in equity with us. So they would anyways are currently also invested in equity. But for somebody who wants to get into equity, if you really do not want at one go, as I explained earlier, you can use iAlpha and stagger your investments over next 6 months or even 12 months, let's say. So that is one way, but short term where markets are going to go, I have no idea.
Yeah, yeah. So anyone who's a long-term investor should look at investing in general. And people who are short-term investors, swing traders, I know people who do that. Some of my friends who, want to track the markets continuously and get in and out of positions. But people who are just here to grow their wealth consistently should focus on the long term and take decisions accordingly.
And if you're really concerned, I think iAlpha is very good to keep your money safe and growing. But don't wait for correction. You really don't know whether the correction would come or not. So do not wait for correction to deploy. Wait for time. Maybe have a systematic plan in place that over next 6 months, over next 12 months, and every month I'm going to deploy this much money in equities, let's say from debt to equity. If you want to invest in equity, that's a much better plan rather than waiting for, let's say, 10-15% correction, which can happen, but you don't know. There have been people, investors just waiting for correction, and the market has grown like anything in the last 2-3 years.
Right. That's very true. Okay, so Nitish Mishra had asked a question in the form. He wants to understand the minimum time period that he should consider while investing in this PMS. And there is a similar question, Vivek, on the expectations of the returns over the next 4 to 5 years. So if you could take both.
So, in terms of time frame, as I told, I think if you're investing in equity, have at least 3 to 5 year time frame. Anything less than that, don't invest 100% into equity. And this is not only for our PMS, but equities in general. So if you have that at least 3 to 5 year kind of time frame, then you can put money in long alpha. But if you really don't have that kind of time frame, maybe consider putting, let's say, 30% in equity, 70% in debt, or 50-50 based on your risk appetite, based on your goals. You can divide between debt and equity if it is less than 3 years. Yeah, that's what. And what was the second part of the question?
The second part was on the return expectations from this product over the next 4 to 5 years.
So return expectations, see, my expectations is about markets would give, I think, 12 to 15%. I expect PMS to have about 5 to 6% of alpha annualized after fees. So that is what my expectation is. Obviously, we have been doing much better than that. But I think our expectation internally also when I talk, and my expectation would be about 6% alpha if we are able to do in long alpha. I think we'll be very, very happy if we are able to achieve that over next 5 years.
Perfect. Sanjay Kumar wants to know the back-tested results of drawdown during 2008, 2013 and 2020. I think we did show 20.
So, yeah, we did show so yeah, we do not have all the data since 2008. That is something we can't share. But in 2020, this is as per the current model. The markets, this is month on month basis, the market was down about 30% and our portfolio, this model was down about 22%. So this was in 2020, and which was the other year? One was 2008. So we have
2008 and 2013.
2013, I think he's talking about this, where markets, actually we saw a bigger drawdown in 2016, where markets fell about 20%, and ours was about, I think, 16, 17%.
Yeah.
And 13 also, we were lower than the broader market.
Okay. Jem Heta asked, which is the most undervalued sector right now?
Again, really does not matter. I can maybe quickly share what are the weights of the sectors that we have in our current portfolio. But this keeps on changing month to month. So our view is kind of, our portfolio takes this view, and our holding period is about 3 to 4 months on an average. So our view is also, in terms of allocation to these sectors, it's slightly shorter term. So yeah, so no meaningful view. We don't really take any views as such that which sector is likely to perform this year.
Right, because it's all quantitative, and our quant models consider that. The team is working on bettering the research methodology, improving that. Right. So few more questions on YouTube, Vivek. Aditya Singhal is asking, does a PMS investor have exposure to the current stocks in their PMS portfolio? Is that through daily reports or via logging into the broker or the demat account? I think by
Not daily, we don't send daily reports. We send reports, the performance reports, on monthly basis.
Right.
But you can log in. We'll provide you a login link to all our investors, and they can track if they want to, even on daily basis. We don't recommend that to track equity investments on daily, but you can do that.
Perfect. Raghavendra is asking, the 0.96% charges, are they only on the profit? No, this will be on the assets under management, right?
Yeah, that's the AUM. There's separate. If you want to consider that profit sharing model, then we have 16%. We'll charge 16% of the alpha that we have generated. So let's say markets gave 12%, and we were able to generate 18%. So the alpha we generated is 6%, right? So in that model, we'll charge 16% of that 6% alpha that we have generated. That's how it works.
Right.
So these are two separate fee
Model.
schedules. You can opt for any one that you like.
Right. Vivek, can you please share the fee schedule on the screen again once?
Yeah. Yeah, this is it.
Long Alpha. Yeah. So there are three options. There is also a hybrid option where you can choose for both fixed as well as fee above the hurdle rate. So you can look at the rates and do an analysis as to what works best for you. Perfect. I think, Vivek, these are all the questions that I can see. Oh, wait, there is one more that just came.
So Isha, have we seen LinkedIn also? There were people joining in from LinkedIn. So we have taken those questions.
Yeah, Vivek. So LinkedIn, I myself cannot see any questions really. Neither has the team sent me anything. They're tracking both YouTube and LinkedIn, but there have been lots of questions on YouTube, which I have taken till now. One more question. Okay, so a similar thing. Do you use Leo Algo or any other model? LEO, he's written in caps. I don't know what this means.
Okay, I really don't know what is a Leo model.
Okay.
But see, if you want to know more in depth about our PMS or fee structure or any other thing, I think you should definitely get in touch with us. We'll be happy to provide more details if you have any questions. So yeah, but I do not have idea about this Leo model, frankly.
Yeah, and we've also shared details about what models we use, what tools and softwares we use. So you can always look at the recording again and you'll get your answers.
Yeah.
I think that's about it. Right on time. So thank you so much, everyone, for joining, and thanks a lot, Vivek, for your time as well. We look forward to more such webinars in the future and more interest from the audience.